this market is one where the easy answers are gone. It's less about broad sector calls and more about understanding where demand is actually showing up and how capital is being allocated and who can execute. So that's what's driving outcomes right now, and that's where the opportunity is.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. In this episode, I'm speaking with Peter Zabierek, Senior Portfolio Manager on the Easterly Ranger team, where he oversees US and global real estate strategies. Peter is an industry veteran with 25 years of experience in global listed real estate investing, alongside an extensive track record of investment management, innovation, and leadership. Peter, welcome to the podcast.
Great to be with you, Sarah.
Peter, as I mentioned in the intro, you're an industry veteran, so you've obviously seen a number of market cycles. Does this period of dispersion feel different to you? And where do you think investors are getting it mostly right and at the same time mostly wrong?
I have been doing this for quite a long time, and I do think that investors are mostly getting it right. This definitely feels like a more dispersed market than prior cycles, and the pricing in the market would reflect that. But I think that investors are getting it right by focusing on balance sheets and sectors with durable demand. And where I do think that the market may be still underestimating things is in how important execution has become. So as real estate has become a much more operational business and outcomes are increasingly driven by how well companies execute, now is really the time to focus on management teams and how they're executing their business plans, not just the assets that they own. There is also still a tendency to talk about sectors in broad terms, when in reality, the differentiation is happening at the business model and management level.
And can you talk about how real estate fits into that larger picture at the moment?
I think there's a lot going on in the world. And as you mentioned, I've been through a number of cycles, been through the financial crisis, through the pandemic. And I think today, real estate sits right at the intersection of several big structural shifts that are all happening at once. And so on one hand, you've got demographic change, shifts in how and where people work, and the impact of technology, particularly AI, on productivity and space usage. So it's not just a cyclical story as it has been in the past. Right now, it's a structural one as well. So you have both cyclical and structural elements to it. And at the same time, within that cycle, we've clearly moved into a different phase of the real estate cycle. And I think of it kind of like a people mover at an airport. For a long time, when I was earlier on in my career, the industry was being carried forward as rates were falling. Then starting as the pandemic ended and interest rates over 400 basis points, the walkway started moving against us and financing costs moved higher. Refinancing became much more of a headwind than a tailwind. And while we see that today that's largely stabilized for the REITs that we're investing in, the people mover has effectively stopped. So what we find now is that rates are in a range. Most companies that we invest in have worked through the bulk of their problematic financings, and that drag on earnings is fading. So going forward, I think that performance is going to be much more driven by operations and execution. And that's important because now this is a much more fragmented market. You can have decent GDP growth, but weak hiring at the same time. And that creates some very different outcomes across the sectors. So overall, it's a much more complex environment, but one with much more opportunity for investors who can be selective.
What do you see as the main tailwinds for REITs more broadly today in the US? And where are the headwinds coming from?
Yeah, so I'd say I frame it as a mix of strong structural demand in a few key sectors and more selective capital overall. On the tailwind side, the leadership is really concentrated. Data centers and senior housing stand out the most. AI is driving demand for digital infrastructure, as we're all aware. But in senior housing, you have this really powerful combination of demographics, improving occupancy, and limited new supply. And the fact that it just costs a lot more to build these assets than it did years ago means that we're far away from reaching the rent levels where new supply pencils from a development standpoint. Financing costs, though fairly steady over the last few years, have moved higher again. And recently, the cost of capital remains a constraint for many. So we definitely are seeing that. And given what's going on in the world, we are always focused on what's happening on the capital side. But there is still a lot of capital in this system. It's just a lot more selective and more disciplined than it used to be. And that is going to create a bit of a tension. You have strong demand in certain areas, but a higher bar for growth overall. And that's what's driving the dispersion we're seeing today.
Do you see similar trends across global real estate markets at this point?
Yeah, that's what's great about investing in real estate is that you have these trends that are global, but you also have very localized effects and outcomes. So you are seeing some broad themes across the globe, like higher funding costs, less help from valuation tailwinds, and more focus on the operations. But the outcomes are increasingly local, just in really broad strokes. The U.S. remains the deepest and most liquid market. Europe tends to move a little bit more slowly, and Asia can offer some growth, but with a lot more volatility. So global real estate today is less of a single macro trade and more of a collection of local stories driven by local demand, local supply, and local capital conditions.
Well, obviously, speaking against the backdrop of the conflict in the Middle East, how is that changing your perspective right now?
Yeah, I think what we've been doing is watching the news on a daily basis, and it tends to go back and forth quite a bit. But what we're really focused on is really sticking to our knitting and our underwriting from a company standpoint. And as I mentioned before, management has become a lot more important in our underwriting. And so what we're focusing on is what these companies can really control. And so it really comes down to capital discipline and execution from our standpoint. So that's really what we're focused on today.
And in terms of REIT management teams, you've mentioned a few things that they should be focusing on. Any other priorities that you would like to see right now?
Yeah, from a management standpoint, I mentioned the capital discipline execution. I think what is also really interesting at this point in the cycle is talent management. So when markets are more challenging, it becomes harder to retain top talent, keep them motivated, structure incentives properly. And the best management teams are the ones that can stay disciplined, keep their organizations aligned through thick and thin, and position themselves to take advantage of inflection points. And we've seen in the REIT market, those management teams that can do that are being rewarded with higher stock prices. So credibility and execution really matter, and that's what's driving a lot of the dispersion in returns.
And we've also seen lately quite a few changes at the top of REIT leadership, some new CEOs coming in. Do you think there's enough focus on that succession path at the moment?
Yeah, I think there is, and we've seen really in the last couple of days, I won't name too many names, but there have been some very well telegraphed evolutions of the management team. These companies tend to be associated with the management and a lot of times individual personalities. And I think good management teams aren't all about one person or two people. It's really about the broader team. And this one case study that I'm thinking in the apartment space had done a very good job of telegraphing this over not only a couple of weeks or months, but really over a couple of years of providing growth opportunities for kind of their middle level of management, giving them promotions, giving them more responsibility. And so when the teams have evolved and when people have moved up and people have moved out and retired, it doesn't come as a surprise to the market. And in fact, it's been a good thing for stock prices to see this evolution. So I think it's been a priority for boards, and it's one of the key things that they find themselves responsible for, is making sure that succession plan is in place.
Great. And turning to sectors, where do you see the biggest momentum in the REIT sector and other pockets of opportunity that aren't getting as much attention?
Yeah, I think the leadership is really pretty concentrated right now, and there are a few usual suspects. So there's data centers and senior housing. they've been standing out for a number of quarters in a row now. Each time we go through earnings season, the numbers seem to get even better for those companies. But I think it's really important to go one level deeper within each one of those broad areas. And in data centers, again, it's become just a huge part of our investment universe. But within data centers, there are two very different businesses. There are the traditional legacy facilities, those that literally and simply house data, where you'd keep your photos and your videos from your phone. They have to be in a cloud. They have to stay somewhere, and that's where they are within these traditional data centers. But that's just one model. And what we're seeing now are the new hyperscale and AI-oriented campuses. They've been tabbed as AI factories, if you will. And they're something else entirely. They're much larger, much more power intensive, and much more constrained by that infrastructure, so that when people say they like data centers and we see good things happening in data centers, the key question is which part of the market they're referring to. In senior housing, the story is very compelling, but it's also super operational. The way that the REITs have structured themselves it's an OpCo-PropCo structure. The REIT is the property company, and their job really is to find exceptional operators. So the key to success for the REIT landlords is in bringing in and keeping those good operators. And we've seen the cream of the crop in the REIT space do a really good job of that. So as I've mentioned a few times, real estate today is so much more operationally intensive than it used to be. And senior housing is that perfect example. I'd say industrial is also mentioned as a top sector and is definitely supported by long-term fundamentals. I would agree, but I would characterize it today as more of a recovery or maybe even a normalization story after a very strong run, rather than a top-tier story up there with data centers and senior housing. And if I were looking for something a little less obvious, or maybe even hiding in plain sight, I would highlight grocery-anchored shopping centers. Fundamentals there have been super strong. Occupancy is high. We even have rent spreads that have held up really well. And supply, which had been high earlier in my career, is as limited as I've ever seen it. It's not a market where leadership is really broad-based. It's concentrated, and the key is understanding exactly where those sectors are and what the real growth drivers are and which management teams can actually execute on those plans.
And Peter, an important topic today is that of housing affordability challenges. How do you see potential regulations on large institutional ownership of rental homes impacting the housing shortage?
Yeah, this has been a really hot topic in the space for sure. And we have a handful of companies that are in our investment universe that's what they do. They invest in single family rentals. And so this affects them pretty dramatically. But at this stage, I would describe it more of a policy and sentiment story than a true operating one. Institutional ownership is still a relatively small share of the overall housing market. And most of the policies being discussed are pretty early stage and not terribly clearly defined. So while we do see the headlines and we understand that they can impact sentiment and valuations, and they have, the near-term impact on fundamentals is pretty limited. And the bigger issue is whether supply and affordability, which policymakers still appear to be wrestling with, is still the big issue.
So given that, what do you see the impact on the single-family rental business overall?
Well, I think the bigger trend is towards a continued shift to a more institutional, better capitalized platform and build to rent. I think that plays into where the REITs find themselves, and that favors larger operators with scale and operating capabilities, while smaller operators might find it a little bit more challenging. So overall, I would expect the impact on broader housing demand to be gradual rather than disruptive.
And we've covered lots of ground, but any closing thoughts on REIT investing and other themes that you're paying close attention to right now?
Just to, for closing thoughts, I'd say, this is definitely the most complex market I've ever seen in my 25 years. And while it's a much more complex market, it's an infinitely more interesting one. And I would just say that this market is one where the easy answers are gone. It's less about broad sector calls and more about understanding where demand is actually showing up and how capital is being allocated and who can execute. So that's what's driving outcomes right now. And that's where the opportunity is.
Excellent. Peter, thanks so much for your time.
Thank you, Sarah. I appreciate it.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.